If you follow the markets on a daily basis, you may need some Pepto-Bismol. Volatility is back and investors are scared. How do we know this? CNNMoney has a fear and greed index that looks at market sentiment. It's been showing levels of extreme fear recently. The index has 7 indicators. One of them is the VIX, a measure of volatility traders often call Wall Street's fear gauge. It measures the cost of insuring stocks against losses. Generally speaking, when stocks fall, the VIX goes higher. Other parts of the Fear and Greed Index track overall momentum in the market. The index also looks at demand for junk bonds, which are even riskier than stocks, and whether investors are moving more into safer treasury bonds. The last indicator tracks buying and selling of bullish and bearish stock market options. We weight these factors equally and come up with a reading between 0 and 100. The lower the number, the more fear there is. Now, what does this all mean for your portfolio? Extreme fear doesn't sound pleasant, but it can often signal that investors are too worried. Investors were worried that fragile emerging markets could cause a huge sell-off, but stocks quickly bounce back after a small dip. By the same token, when investors are too bullish, stocks may need to cool off for a bit. As the S&P 500 approached the 2,000 mark in June, the Fear and Greed Index was in full-on extreme greed mode. Stocks then pulled back, and the S&P 500 didn't close above 2,000 until late August. And that was only after the Fear and Greed Index moved back to extreme fear first. In other words, follow the advice of billionaire Warren Buffett. Be fearful when others are greedy, and be greedy when others are fearful. And that's the buzz. Follow me at LaMonica Buzz on Twitter.